Welcome back to Switzer on Australia's Business Channel. Now, we lived through the best month for the stock market in 22 months and Wall Street is in record territory. So how is Marcel Von Pfyffer playing equities going forward? The founder of Armenius Capital joins us now from our Brisbane studio. How are you, Marcel?
I'm very well, Mr. Switzer. How are you, Peter?
Good. Now, I'm going to sort of get inside that complicated economic mathematical head of yours and trying to work out whether we stay in this market and ride it up, or do we actually just take our profit and cool our heels for a while. Summary from Marcel Von Pfyffer?
I think things have run pretty well. If Governor Glenn Stevens does cut rates in the month of August, that'll lend some further legs to the market. So if that doesn't happen, then I think some profit taking would be prudent. Yes, but as I say, if he does cut rates further, then there will be an extension leg to this this wonderful rally that we've enjoyed through calendar 2013 so far.
Okay, so I was trying to work out. They asked me on the Sky News channel earlier to work out why the stock market did very well, and I jokingly said, well, Kevin Rudd became Prime Minister on June 26. In fact, the market's up. Ever since Kevin became Prime Minister, the stock market is actually up 8.5%. Some cynic says because Julia Gillard is no longer Prime Minister, which I think is terribly unfair. But yes. Then the real reason I put it down is that Bernanke basically said, hey, you misinterpreted me. I'm not going to taper in September. That was a standout reason, surely.
Yeah, most definitely. The market had a very tough time actually interpreting Bernanke's comments, to the extent that, as we know, Bernanke then had to appear again before the Senate House Finance Committee, I think it was, yep. And actually had to emphatically, categorically in English, or in American English, explain to the market precisely what he was actually talking about, yep. With the resultant effect that the market settled down. Yeah, but as far as political impact upon stock markets, it's about the same as GDP numbers have correlation with stock markets. There's very low correlation. And again, there's a very famous study done years ago where you can empirically actually correlate Bangladeshi butter production against the returns of the S&P 500.
OK, I must get a dairy farmer from Bangladesh on the television program then. All right, now, so there's Bernanke, and that helped the international scene. And locally, well, interest rates have been coming down, and you say that's going to be another positive stimulus for the market. But also the dollar's been a help too, hasn't it, Marcel?
Yeah, look, we go back to when the dollar got to about $1.10 and a bit back in 2011. Since then, as we sit here tonight, before I came on, we're at about 90.3 cents. So the dollar's fallen in extremis of 21% so far. It's entirely possible that once the dollar reverts back to its long-term average, again, it's not out of the question. The only question here is point of time, but it's not out of the question that we'll actually go back to hovering around a 75, 80 cent level. And I don't want to alarm any viewers or anything. Again, that could be anywhere up to 3 to 5 years away. But again, there is potential, significant potential, for another 20% downside to the Australian dollar from where we sit. And should Governor Glenn Stevens continue on his rhetoric and the speech that you referenced when you were speaking with Mike just before the ad break there, you know, the tone that he's taking in a number of recent speeches, when he was up here in Brisbane presenting to the Australian Economic Society a few weeks ago, he passed what was a partial central banker joke as it came across, and the currency markets interpreted that because of course his transcripts are released to the market on the RBA website actually just before he delivers them in person, but he deviated a little bit, joked about cutting interest rates, that they deliberated a long time before they actually made the decision at the last meeting, and the dollar fell over a cent and a bit as well. So yeah, the potential is there. A lower Australian dollar will benefit certain industries and certain sectors in the Australian economy, but not all. And of course, we must remain steadfast in understanding that Stevens is not cutting the interest rate because things are good. You know, if the Aussie dollar does fall down to 88, 85 cents because of pending or implicit cuts, loosening of monetary policy by the RBA, he's doing that for a very good reason, because he thinks that the Australian economy needs his help, or needs the help of looser monetary policy.
Without a doubt. Now, I know you have an enormous love and respect for Europe, but you have been a bit of a Eurosceptic, haven't you? But we've been seeing some good things happening in Europe and even the UK, two quarters of positive growth. Could things be just on the turn for Europe, and then maybe they will look a lot better in 2014, Marcel?
No. I'm sorry.
Okay, so you're still a Eurosceptic.
I am. Look, again, the problem that they have over there, they've got structural issues. They do not want to go along with reforms that, whatever your political predilection, whether you're a Keynesian or a monetarist or whichever school you come from, the sad reality is that there are structural problems in those economies, probably bar Germany. Yes, the United Kingdom has had a couple of quarters now in a positive light. But again, as we said in the program about 2 weeks ago, these countries are coming off a very low base, Peter. So yes, in a percentage change metric, their GDP does look like it's increasing. But again, these countries, and look, I'm very happy to say this, that my position and my perspective, with the exception of Germany, is that some of these countries in Europe, we're not talking about 3 to 5 years. These guys have got a decade in which they need to significantly reform their economies, change the structure of their economies, until they approach anything with a semblance of pre-GFC type growth and total GDP size of their economies again.
Okay, so therefore you would not be looking for a fund manager who's playing Europe?
There will always be isolated pockets. If you've got a fund manager who can go short in his mandate, possibly. But again, look, they're coming off a very low base. But the euro itself, again, you'd have to take heed as to whether you're having a hedged or an unhedged exposure. The euro, because Mario Draghi, God bless him, and still is standing by his comments that he'll do whatever it takes to save the European Union's economy. But what that actually means is that whatever it takes means that he will weaken the euro to such an extent. So he's very, his foot is hovering just off the accelerator, and he's very happy to cut interest rates in the European Union should he deem that rate cuts are necessary. So again, if that happens, go back to the example that I just said about Stevens, these guys who are running the central banks, they only cut rates when things are not going well.
Okay.
And of course, as soon as you cut rates, your currency falls.
So the bottom line is we plan European holidays and not US holidays. And on that subject, US holidays, do you think the US scenario for 2014 is going to get progressively better, and that US stock markets will keep creeping up over that time?
Yeah, I actually do. I got a piece across my desk, a global investment strategy outlook from a certain US desk of a Swiss bank whose first two initials are U and B.
Gee, what was that?
They're exceptionally...
UB40, was it? Go on.
Something, exactly, UB40. So there's a lot of optimism over there about their economy, and so there should be, quite frankly.
Yeah.
The labour market is bouncing back, but most importantly, alongside a slight to moderate improvements in overall employment levels, which is great because that drives consumption, as we know, is the fact that the household market is currently enjoying rates of growth that these guys haven't seen since 2006. And as we know, or we should know, is that in the US individual investors' money, so the majority of their net wealth, is not like in Australia held in the stock market, it's actually held in their own house. So this is why the GFC, or as they call it, the Great Recession, hit the average US mum and dad so hard because house prices plummeted. So we've seen, as I say, the best increases now since about 2006. The Case-Shiller Housing Price Index is going gangbusters. The labour market is putting numbers back on, which means the consumption is up. And again, we've seen the rotation from the market weighting, the cap size of these massive resource companies as the commodity boom has sort of slowed down, return to financial stocks in the US. So a lot of the capital flows are going back into the financial stocks, and whether you think that's a good thing or a bad thing, that's a question for another evening. But historically, when US financial stocks do well, the economy overall does well, and that will lead to further impetus and I believe further gains in US equities as we go through 2013 and into 2014.
Marcel, as always, great to listen to your great observations on the markets and how to invest. Thanks for joining us. Talk to you in a couple of weeks' time.
Take care. Thanks, Peter.
After the break, even the RBA governor is worried about weak business confidence. So what does the latest Deloitte CFO survey show? Find out next.